Hey everyone, good evening and welcome to MYTHEO Live. My name is Roshan Kanison, Head of Content and Strategic Partnerships here at MYTHEO. First and foremost, can everyone hear me loud and clear? Just give me any responses in the chat, just to make sure that anyone can hear me at this point. But in the meantime, all right, great. Thank you, Michael, for the response. At least I know my audio is working. So as I mentioned, my name is Roshan Kanison, Head of Content and Strategic Partnerships here at MYTHEO. MYTHEO is a digital investment manager, more commonly known as a robo-advisor, licensed by the Securities Commission of Malaysia. Now, in this evening's edition, we dive into the question, how do US elections impact stocks and financial markets? Now, as we speak, the Democratic Party's hold over both chambers of Congress is in question, leading into the midterm election, which is happening as we speak. The Democrats have a majority by a very, very slim margin, making this a very important midterm for the White House in a very tight and important contest. If the Republicans take control of either chamber, we could see gridlock going forward in a very partisan environment that we're in until the next presidential election and congressional election. But putting all that aside, let's take a look at the question of how US elections have impacted stocks in the past, right? And we'll get into that in just a little bit. But first, some housekeeping. Now, first things first, ladies and gentlemen, among other statements on the screen you'll see right now, please note that this presentation is for general informational and educational purposes only and should not be taken as financial advice, right? If you're looking for financial advice, go seek that from a financial advisor. Also very important to note that please keep in mind that past performance is not a guarantee of future results. And if you have any questions whatsoever, we are always very happy to take questions during these sessions. You will see a little Q&A box in the Zoom options. Just click that box and drop your questions in there, and we will take them during the Q&A section later on after the presentation. Now, a little bit about me, as I mentioned earlier, my name is Roshan Kanison. And a lot of things one of the primary things I like to describe myself as is personal finance nerd, which is reflective in the career that I've had, right? I was in BFM for a while running the Ringgit and Cents show. I was a financial planner and financial educator for a little bit as well with Ringgit Plus. And now here at MYTHEO, I'm helping them with their content. I'm helping them establish partnerships. But all through that is essentially this enjoyment and this nerdiness around financial information, financial health, financial productivity, and which I hope to which I hope to illustrate later on today. Now, before we get into today's session, I'd like to introduce to those who may be new to MYTHEO, or for those who are already customers, a little bit of a refresher. MYTHEO is a digital investment manager licensed by the Securities Commission of Malaysia. A lot of you may be more familiar with the term robo-advisor. Now, aside from making investing cheaper, more accessible, and highly personalized, here at MYTHEO, we take the difficulty out of investing. Now, as Warren Buffett famously said, investing is simple, but not easy. And oftentimes the reason for this difficulty in investing is our own emotions and behaviors. As our CIO, Chief Investment Officer, Matthew Stuart-Box recently told BFM Radio's Ringgit and Cents, we are our own worst enemy when it comes to investing. I'm sure this is a sentiment that isn't isolated. And oftentimes it's because our emotions get the better of us during both times of fear, like we are in now, but also times of greed, like we were in just 2 years ago. And this, as we've seen from the data, has led to negative investment decisions. So to address this, what MYTHEO has done is it's tapped into the power of algorithms and ETFs to remove the emotional decision-making from our investing strategy. Now, I know everyone is excited to get into today's topic, 14 of us already here. But before we go into that, I think one great way to illustrate this part of it, how we've used the algorithms, is to show you the functional portfolios. Now, these three functional portfolios that you see on screen right now are blended together by the profiling algorithm to build you a personalized portfolio. Now, why I'm highlighting this in particular, because it highlights the technology behind the platform here. Each of these functional portfolios that you're seeing on screen are managed by their own algorithm to ensure that we're using qualitative analysis and not emotion or gut feel when we make investment decisions. Each of them has their own algorithm managed because equities will need a different investment decision matrix compared to something like fixed income or inflation hedge portfolio for that matter. So just for illustration's sake, based on as of August 2020, this is what the growth portfolio looks like. Yes, it's predominantly or about 50% in the US, but that is the makeup of the global equity market, right? But essentially, the algorithm is constantly ensuring that the valuations and quantitative analysis that we use is based on the academic literature, the investment portfolio theory, to ensure that we are making the best decisions possible. Same for the income portfolio and the inflation hedge portfolio. Now, I don't want to spend too much time here, but if anyone has any questions of any of this later on, please put them in the Q&A section, and we'll be more than happy to take them up later. Now, at a glance, this is what MYTHEO does. You answer 5 questions. We take our ETF universe and we build the portfolios. Now, on to today's main topic of the day. It's why you guys are here right now. How do US elections impact stocks? Now, I'm not the best person to speak about this, but this man right here, Matthew Stuart-Box, may know a thing or two when it comes to investing. Matthew is, prior to Money Design, he was with BlackRock Japan for, I think, about 20 years, if I'm not mistaken, Matt, you were there. And one of the things that you were managing, one of the primary things there was you were head of scientific active equity, where you were managing Asian equity portfolios of around $10 billion in assets. That sounds very, very impressive and maybe a bit high level for us, Matt. So could you maybe just break down a little bit? Like, yes, you did math in Cambridge, you did economics in Tokyo, you were in BlackRock for 20 years, but what was the core thing that you've been working on in your career?
Thanks, Roshan. Yeah. I mean, my focus was stock selection within Asian equities. And so what we were doing, we were building fundamental equity models using various signals to try and identify, high quality, reliable companies, and then applying those models across as broad a universe as possible. So we would hold universes of perhaps 1,000 different stocks or 1,500 different stocks, and try and build portfolios to outperform their benchmarks.
Right, so that's where the math comes in. Right? The math meets the investing world in the sense that you've built those models based on quantitative fundamental analysis, which coincidentally is very similar to what I was talking about, the algorithms that we employ here at MYTHEO. Now, if anyone, again, has any questions about the MYTHEO portfolios, the algorithms, please feel free to drop them in the Q&A section, and we'll take it later. But for now, Matt, we have more important things to discuss, like the impact of US elections on stocks. I hand the screen over to you.
Okay.
All right, perfect.
Okay.
So I guess the first question, Matt, which is pretty straightforward based on the theme that we're taking on today, how have stocks and financial markets performed during past election cycles? Could you give us some background sure. And some data here?
Yeah, sure. I mean, it's a very interesting topic, and obviously there's plenty of research that's been done on it. So I'll maybe kind of give you a quick tour of kind of what people have found looking at this. Perhaps if we start just with the basic election cycle itself. Obviously in the US, it's a very regular election cycle. Every 4 years, we have a presidential election. And there's loads of research on how the stock market performs through this cycle. And the common kind of result that comes out is that in this 4-year cycle, US stocks tend to outperform in the 3rd year of the cycle. So Biden started his presidency last year. So we are currently in year 2 of the presidential cycle. And so the 3rd year of the Biden cycle would be next year, 2023. And if we look at the data, this is what it looks like. This is from a very long history. This is looking back 180 years of data, splitting it into these 4 years of the cycle. And it shows the average return of the S&P in each of those years of the cycle. And you can see year 3, labeled here as the pre-election year, it's the year before the presidential election, is a year in which the S&P tends to do pretty well, just over 10% average return. But this is for a very long data set. We can also look at, whether this is still relevant or still valid more recently. And if you look at a bit more recent data, this is looking at various different periods in the more recent history. Perhaps this one here is the most relevant one. It's since looking at the data since 1981, so roughly the last 40 years. Here you can see the same kind of analysis over the 4-year cycle. And US stocks do tend to perform well in the 3rd year, and also over the last 40 years or so, the 1st year of the cycle as well. Obviously, depending on the period of that you take, the results are a little different. But you can see that the 3rd year, this grey bar, is consistently pretty strong, no matter what kind of time period you take. The other thing you can think about is, obviously, with the US presidency, you can have a first term, first 4 years, and then a second 4 years if the president is re-elected. So you can look at whether this pattern is visible in the first term of a presidency or the second term. And what the data shows is this tends to be stronger in the first term of the presidency. So when the president has just been elected for his first 4 years, this outperformance in the 3rd year tends to be very strong. So this is the same data split into, on the left-hand side, data from presidents during their first term, and on the right-hand side, the data for the presidents during their second term. And you can see for the first term, this year 3 outperformance is very strong. You look over the last 40 years, it's 20%, 21% average return of the S&P during the 3rd year of the presidency. Whereas if you look at presidents in their second term, there's lots of other things going on. They're kind of perhaps winding down their presidency, turning into a bit of a lame duck, perhaps. And you see the effect is much weaker in the second term.
It's just a sliding scale down.
Yes. It's a bit scary, the second term, yes. Obviously, Biden's in his first term, so, from that point of view, you could argue things look good for 2023 in terms of potential returns. And, the Biden presidency so far does fit this pattern of the first during the first term. In his first year, which was 2021, US stock returns were strong. In year 2, which is this year, obviously things are down. It's down, 17, 18% year to date. And so far, Biden is kind of fitting this pattern. But obviously, there's no guarantee of anything happening in the next year. But of course, with all these things, the sample size is small. We don't have a large number of presidents to analyze. And there's quite a lot of variation case by case. We'll perhaps maybe look a little later on at individual presidencies and see that. But there's a large variation. So it's hard to make a conclusion. And obviously, this is just showing correlation, really. There's no evidence here that these stock market returns are caused by the presidential cycle. They just seem to be aligned with it for some reason. And you could argue anyway that these 3rd year returns simply are because of perhaps higher risk in the 3rd year of a presidency. That might be a reason why you'd get higher returns. So this is interesting, but probably you shouldn't be placing big bets based on this kind of analysis. But that's the general kind of election cycle. If we look more specifically at the midterms, there's obviously been a lot of research also done on this kind of midterm effect. How does the stock market perform in and around the midterms? And obviously, these elections happen halfway through the presidential cycle. And as you mentioned, Rosh, these are elections for the House of Representatives and the Senate. And what we see here is the US market in general tends to struggle, perform weakly before the midterm elections, and then recover afterwards. And so this is from research that looked back over the last, I think it's the last 60 years of US elections. And the thing to look at is this row here. it looks at the performance of the S&P 500 in the 12 months leading up to the midterms. And here you can see on average, the S&P is essentially flat over that period. And then on this side, it looks at the S&P in the 6 months and the 12 months after the midterms. And you can see a good strong rally, 15–60% rally on average after the midterms. And so there is some evidence, at least, that once the midterms are out of the way, there's an element of some kind of relief rally in the US, and perhaps we'll be able to see that again.
This is really interesting, Matt, because these are things I think that have been talked about in the media. Things like maybe the markets are waiting for some kind of certainty before they start to price in their optimism or lack of optimism. We'll talk about gridlock later, because that's always a hot topic. That gridlock leads to better markets. But one thing though, before we get there, is there's often this connotation or this idea that one party is better for markets than the other, right? And traditionally, it seems to be, the Republican Party is generally more historically tagged with market and business. So based on the data that you've taken a look at, does the market perform better with either a Democrat or when either the Democrats or Republicans are in charge?
Yeah, so this is a very good question, and I think the results are a little bit surprising. Certainly, I was quite surprised to look at these. First off, let's look at it from the terms of kind of the real economy, in terms of GDP growth, and so we can look at whether GDP growth in the US is stronger when there's a Republican president or when there's a Democrat president. And if you look at the long history, surprisingly, GDP growth tends to be higher under Democrat presidents rather than Republicans, which was, to be honest, a little bit of a surprise to me. I had the same kind of image as you, in terms of Republicans being, in theory, more business friendly. And yet, when you look at the data, it's a big gap, 3%. And so this is the data. This is from a research report from the National Bureau of Economic Research in the US, so a very respected research institution in the US. And they looked at GDP growth. This top part here is over the last, 80 odd years. And they look at the average GDP growth during those 80 years under Democrats and Republicans. And you can see 4.86% GDP growth under Democrats, 1.7% under Republicans, and so a difference of 3.16%, and that's reasonably significant from a statistical point of view. However, if you look a bit more recent data, and so at the bottom of this table, it uses the same data, but it just uses a shorter window, just since 1987. Then you see the gap is much smaller, 2.9% under Democrats, 2.2% under Republicans. And so that difference is 0.7% is probably not statistically significant. So you could argue that perhaps over a long horizon, there is some evidence that the economy does better under Democrats, but recent evidence is pretty weak in that area. But then how about stock returns? Well, you can do exactly the same thing and look at the returns of the S&P under Republican and Democrat presidents. And here we see a very interesting result.
Wow.
Stock returns are nearly 11% higher under Democrat presidents than Republicans. And these are annual figures, so 11% per year on average higher under Democrats than Republicans, which again was really quite surprising to me. This is what the data looks like. It's from the same research. And here we've got a timeline showing annual stock market returns under the different presidents. Obviously, red is for the Republicans, blue is for the Democrats. And you can see there's lots of variation. But when you take the average over this whole period since 1927, the average return under the Democrats is this 10.7%. And under Republicans, it's actually, the average is actually minus 0.2%. And so that's what gives you this difference of 10.9%. And in this case, even if you look at more recent data, it's still there. The effect is still there. This part down the bottom here, just looking over the last 50 years or so, has essentially the same result, a nearly 11% spread, which is quite surprising. But then when you look in a little bit more detail, you could argue that perhaps it's just the Republican presidents are just plain unlucky. Think about where all these big negative events happen. The 1929 Wall Street crash, obviously, this is this big drawdown right at the start here. That happened under President Hoover, a Republican president. The first oil shock in the 1970s, that happened under Nixon and President Ford. The 9/11 attacks, Lehman shock, those both happened under George W. Bush, and were very negative for the stock market. And so you could argue perhaps this is not causality here. Republicans are not causing these bad returns. They just happen to have had unlucky presidents, perhaps.
Yeah, because if you look at this chart here right now, because that was one of the first things that popped out, right? If you take a look at the first red bar, it really does offset that data. It does imbalance it. But even when you start to look at the shorter timeline, like you mentioned, from 1971, that spread still maintains. And it's hard to argue that the dot-com bubble was George W. Bush's fault, right? While on the flip side, Bill Clinton's presidency benefited from the dot-com bubbles, the tech rally that we saw then, and then Obama's administration benefited from the low base effect from the GFC. So this is really, really interesting. But this has been largely US-centric, right? And considering that the US market is such a large part of the global equity market, based on the data that you've been looking at, is there any potential impact? Is the potential impact here limited to just the US stock market, or are there impacts globally as well?
Yes. So you'd expect, this is US politics, and maybe it has some relevance outside of the US, but you wouldn't expect to see such a strong result outside of the US. It turns out that actually, certainly when you look at other developed countries, then the effect is still there. And so this is from the same research report. This is looking at the average return of stock markets in various different countries. And what they've done is they've taken the average return during US Democrat presidencies and subtracted the average return during US Republican presidencies. And so, for example, you can see here in Australia, the Australian stock market performs 11.31% more under Democrat presidents than under Republicans. And Canada is 13.6 and so on. And so, as you said, the US economy is so large, and certainly the US stock market is so dominant, you might expect to see at least some similar effect in other developed countries. But I was very surprised to see that the effect is basically at least as strong as in the US. And I suppose this just comes back to how dominant the US stock market has been traditionally for developed markets.
And I guess it also speaks to the global nature of financial markets as well,
right,
because money does move around the world. Like what we're seeing right now is, and now obviously it's a lot quicker and a lot more dynamic. If the US opens or closes, if the US closes in the red, then we expect to see Asian markets open in the red, or there's always some kind of in terms of where the money flows. But when we take a look at the investing landscape, more specifically to MYTHEO's position, does MYTHEO take a look at this? Are we positioned to take advantage of these long-term trends, or is our analysis more? How do we take a look at this kind of data?
Yes, yeah. So this stuff is all very interesting, but just to be clear, MYTHEO does not take positions based on things like election cycles, things like that. So we certainly haven't changed our positions within MYTHEO on account of the US election cycle. We've seen there is some evidence that the market outperforms under certain scenarios, but it's probably not something that you'd want to put a big bet on. If you look at kind of how our portfolios are positioned right now. This is our main growth portfolio. So this is the equity portfolio. And you can see a couple of things here. On the left-hand side here, these are all of the different ETFs in the portfolio, showing their size of the positions. And you can see, there's a large amount of diversification in the portfolio. We own quite a lot of, obviously, US positions, but also a whole load of other developed markets, emerging markets. We have positions in India, South Korea, Mexico, things like that. And even within the US, it's not just a generic kind of S&P 500 position. Actually, the US market is a bunch of different markets altogether. And so we have, for example, a value-focused ETF, a growth-focused ETF. These two together give us exposure to most of the US large cap. But also there's a very important small and mid cap element to the US market. And so we have positions in small cap, mid cap, very different parts of the US market. So it's important to realize that, the US market is not one single entity. There's lots of different kind of subparts to it. And we've found that over the longer horizon, building a portfolio that is diversified across different markets, different regions, different parts of the market, is the best way of kind of efficiently capturing these kind of equity risk premiums, rather than trying to time a particular market or a particular part of the market. Building a portfolio that's going to be diversified and pick up the equity risk premium in the most kind of risk efficient manner is probably the best way to build your assets in the long run.
All right. And Matt, you say things like equity risk premium. This is portfolio management theory. It's based on the academic research that's been done over the last 40, 50 years. And I guess that's also a part of the component of why why value has been split from growth. So it's so that the algorithm over the longer term can take advantage of valuation differentials. So, again, this is all a bit over my head. This is more in your ballpark. But it allows for more, because there are always going to be times where people say, oh, growth is overvalued, or, value is undervalued. There is a way to position that in a passive but effective way over the long term.
That's right. Yes. So there's lots of academic research that shows that, in the long run, there is a premium for holding growth stocks, and there is a premium for holding value stocks. But the relative risk of those different kinds of stocks moves through time. And so what our algorithm does is we don't try to predict when each of these is going to outperform, but we do adjust our positions based on the relative risk of those portfolios. And so right now, we're roughly equal in value and growth, maybe just a little bit more value than growth. And that's because based on our algorithm, we're seeing value as having less risk than growth at the moment.
Right. Now, if anyone has any other questions, please do ask us in the Q&A box, and we'll take a look at them later during the section. We've got a few more questions to get to before we get to the Q&A section. Now, Matt, this is a question I alluded to a little bit earlier. I talked about gridlock, and this is a comment that's often made when we talk about politics, but particularly U.S. politics, that having political gridlock in Washington D.C. is good for markets because nothing moves, the market knows what to expect, and that's what market pricing is a lot of the times, right? It's trying to price in expectations of the future today, and if people expect nothing to happen, then there's a bit more bullishness in terms of how we can. What is there to expect? But if you've got a full red deck over here or a full blue deck over here, there's a lot more, seemingly a lot more push towards a possible policy changes on a macro scale. What have you, I guess, when you took a look at this question, what did you find?
Yeah, sure. Yeah, so this is a fascinating question. Yes, this idea of whether gridlock is good for markets, and as you say, there is a general feeling that probably gridlock is positive for markets. As you say, perhaps it means there are no kind of big policy surprises. Or you could also argue perhaps that, gridlock forces the two different parties to find some compromise between them in order to get anything done. They can't, one single party can't push something through on its own. And so perhaps that element of compromise means you get some better results potentially. But if you look at the data, this is a very useful study that was published recently. It looks back over the last nearly 80 years, and it splits up the time period into what they call unified government. And so this is where the president and both houses of Congress are all from the same party. And then it looks at different cases where you have a president from one party and Congress is controlled by people from another party. And the first thing to note is this unified government, so where both the presidency and the House the Congress is from the same party, actually gives pretty good returns. I mean, this is like, on average, the S&P returns 11.2% under these scenarios. So in that sense, this is the opposite of gridlock. This is a fully coordinated government, and that actually is quite good for markets. What you can see, however, is this only occurs out of this total sample. This is a sample of what, 70, 75, 77 years. This only occurs less than half of the time. So for more than half of the time, there's some kind of split between the presidency and Congress. And what comes out here is the S&P's returns are actually strongest in these split environments. And in particular, these cases where you have a Democratic president and the Republicans controlling Congress. So the Republicans holding both the House and the Senate. In this case, the average return of the S&P is 13%. And then in this final case down here, where we have a Democratic president and the Republicans holding one part of Congress, then the S&P return is actually at its highest, 13.6%. So it's very hard to find a good reason why this should be the case, because if you look at the case where we have a Republican president and a Democratic Congress, then performance of the stock market is very weak. But at least on this basis, there is evidence that gridlock in the form of a Democratic president and a Republican Congress is good for stock markets. Obviously, the normal caveat is, if you look over here, the number of years involved, the sample sizes are pretty small. There's only 4 years. So essentially one presidential cycle where we've had this kind of Democrat president and a split Congress. So, the number of cases involved in this calculation is pretty small. But if you accept that, then there is at least some evidence that gridlock with a Democratic president, which is perhaps the most likely outcome from these elections, is relatively good for the stock market.
And I do really want to emphasize that point, right? The sample size here. There are some scenarios here which have 20 years of data. Some have 4, as you noted. In fact, the scenario with the highest average return is the smaller sample size. It's 4 years, which is 1 presidential term and 2 congressional elections in there. Yes. So again, I think highlighting what we said earlier as well. This is all very interesting stuff to kind of piece together and take a look. And it was an important question, I think, to dive into. But I think when we take a look at the aggregate, it's interesting, but maybe correlation as opposed to causation, maybe something to keep an eye on. In fact, Matt, let's get into the crux of the question is when we take and summarize everything that we've talked about over the last half an hour is, in conclusion, do US elections tangibly matter to financial market performance? Yes, the question of them all.
Yes. So maybe if we just kind of summarize what we've got so far is, so there is evidence that elections do matter, at least for kind of short-term market performance. And the evidence points to this idea that markets do better, stock markets do better, A, under Democrat presidents, B, in this kind of third year, and in particular, in the period immediately after the midterm elections, and C, with this element of gridlock, where you have a Democrat president and Republicans holding at least part of Congress. So there is evidence that supports this kind of scenario. But as we've said many times, statistically, these are not particularly strong results because the sample size is so small. But the thing to note here is you've got to take a long-term view on this kind of stuff. This is a very common chart. This is the S&P going back nearly 100 years. And you can see there are ups and downs and kind of wiggles in this line. But, at any point in time, these drawdowns are quite dramatic. Some of these are quite big, and to have lived through them is quite shocking. Things like the IT bubble bursting, the Lehman shock, these kind of things. They're big events. But when you look at it over a longer horizon, perhaps the horizon of a young investor who's looking at like a 30, 40, perhaps a 50-year horizon, then what really strikes you is not those events. It's the fact that there's a very regular upward tilt to this graph. And the stock market, in this case, it's the US market, but it's equally true in terms of global markets, has a positive long-run return of between 7-8% in the long run. And there will be ups and downs along the way, but those ups and downs are much less important than this long-term drift upwards. And so for a long-run investor, you're better off not trying to kind of predict or react to shorter-term events like these kind of presidential elections or Congress elections. You're better off staying in the market. And that way, at least you're guaranteed to pick up whatever kind of long-term drift upwards there is. Jumping in and out of the market raises the risk of you missing some kind of rebound, missing some uptick. Investing regularly is very valuable. Most people don't have a large lump sum of cash to invest at a point of time. But getting into the habit of, say, every month putting aside a fixed amount of money into the stock market is a very good way of ensuring that you build your assets gradually over time. And then the important thing is to stay diversified. This is the returns of the S&P 500. So it's the 500, essentially the 500 biggest stocks in the US. This graph could look very different if it was just a individual sector, or even worse, if it was just a small group of 3 or 4 stocks. There's no guarantee that you're going to get a long-term upward drift if you have a portfolio that's just, say, 3 or 4 stocks or one sector. The way to have the best chance of picking up this long-term drift is to avoid concentration in any individual sector. So I think that's a very important element of any investor's portfolio.
Yeah, and if I could just highlight that again, when we take a look at, because there's always a lot of good information about investing, and the highlights that always come up are things like exactly that, right? Staying invested, investing regularly, staying diversified. But it's important that these are done in combination with each other, because once you start siloing it out, it could lead to disastrous results. Because if you're investing regularly, but you're not diversified, you could be investing into an industry that goes nowhere, right?
Yes.
Or if you're investing in a single stock, these things can go to zero. Sectors can disappear. But the entire financial market, the entire stock market has so far not disappeared on us over the last few hundred years of data. So adding these 3 things together is what gives us quality dollar cost averaging over the longer term, doing it while it goes up and doing it while it goes down. Because if you had bought a lump sum of, if you had invested in the S&P, 80% of your wealth at the beginning of this year, you would be feeling a lot of pain right now because you wouldn't have enough cash to average that out, right? But if you were dollar cost averaging throughout this situation, every new, yes, it's weighted towards the initial deposits, but because it's relatively smaller size, smaller ticket sizes, there is a better chance of averaging it over the long term as opposed to having a heavy weight at the beginning. Ladies and gentlemen, that's pretty much the question I have for Matt at this point. If anyone has any other questions, please drop them in the chat box or in the Q&A. We have a few questions that were sent to us before on Instagram, so maybe we can go through that first, Matt, before we get into any other questions if anyone has them. All right, so there's one question that came through on Instagram asking the question very simplistically: is now a good time to invest? So, I mean, the same caveats I think will apply in the disclaimer itself. But Matt, I think you have put together some data on this for us.
Oh, okay, right. Yes, yes. So this is a question that often comes up: is now a good time to invest? Should I get in now, or should I wait? And there's lots of kind of different ways of kind of people thinking about this, thinking, maybe the market's going to go down, so I should wait. Or people thinking, maybe I should wait until some of these risks kind of fade away a little bit, until we get some clarity on, say, the course of interest rates or the course of GDP growth. And I can understand those kind of sentiments. I mean, that's a perfectly natural thing to do. Maybe a good way to look at it is perhaps we go to this slide here. This is a useful one I've used a few times. This is this idea of like, does when you start investing, does it really matter? And what I've taken here is like MSCI. This is global equity returns, and looked at the kind of range of returns that you could get depending on your investment horizon. And so the left-hand side here is if you were just investing for 1 year, if you were just going to put some money into the MSCI All Countries Index for 1 year, what kind of returns could you expect? Well, the average return for the MSCI All Countries Index is just under 10%. And so that would be what you might expect. And so that's that red dot in there. But depending on the year that you choose, you could get very lucky and get a return of nearly 50%. Or if you were very unlucky, you could get a return of nearly minus 40%, depending on the year that you chose. So if you're just investing for a very short horizon, a 1 year horizon, there's a very large range of potential outcomes that you could experience. But as you see, as your investment horizon gets longer, if you're going to hold it for 2 years, for 5 years, for 10 years, you see that the range of potential outcomes gets narrower. And this makes sense because, some years are very good, some years are very bad. They tend to kind of average themselves out. And so if you say, look at a 10-year horizon, your expectation, the average that you're likely to get is pretty much the same, just under 10%. The best return you could get is about, if you were very lucky, you could get an average annual return of just over 15%. Or if you were very unlucky, you could get an average return of I think this is about minus 3% here. And so it's much a narrower range than a 1 year horizon. But when you get out to, say, like a 30-year horizon, so if you're saving for your retirement, 30 or even a 50-year horizon, then you get even more scope for these returns to average themselves out. And so the range of potential returns gradually gets narrower and narrower. The average stays the same, but you're probably going to get something in the range of between 10% and perhaps 7%. And so this idea here is like, if your horizon is very long, then it doesn't actually matter when you start. The important thing is that you start, and as you said, you stay in the market for that whole period. And so this worry about, is now a good time to start? Should I wait a couple of months? Should I wait, 5 months, 6 months before I start? Is perhaps not the right way of thinking about it. If you are planning to invest for a long horizon, the thing to do is start now and maximize the amount of time that you're in the market, and that maximizes the likelihood of you getting a good return.
All right. Okay. We have no questions from the Zoom audience at this point. But Matt, as I noted earlier, we do have some questions from Instagram. We can go through them first. And if there are no questions by the time we get to the second question, then we can wrap up. It's about 9:45. We've got another 10, 15 minutes to go. So the other question that we got, Matt, so maybe we can, that we got on Instagram was, have there been any past US presidents or elections that were particularly good for markets? And is there anything we can learn from it, right? So I think they're looking for the outliers in these situations, or were there any presidents that were particularly unfriendly or bad for markets?
Yeah, sure. So this was some data I found of exactly that. Yes, US stock market return. So it's got like the Dow Jones Industrial Average and the S&P 500, but they're similar kind of returns for these various different presidents going back the last roughly 80 years or so. And so you can see President Trump down there. He did pretty well, but so did Obama, and they both had strong returns. I think what kind of stands out is not so much years that were particularly good. You can see there's very few presidents that are kind of stand out positive. Maybe Bill Clinton was the best there with like an average of 15%. But what does stand out is the presidents that had the worst returns. And see here you see President Hoover. This was the Wall Street crash. Nixon with the first oil shock at the start of the 1970s. George W. Bush with two big events, 9/11 and the Lehman shock or the GFC. And then President Carter, who had a combination of high inflation and an oil shock. And so you can see these presidents have had to deal with big external shocks. Naturally, have tended to have the weakest returns. But then it's the presidents who come after them who tend to reap the benefit of this rebound. And so you can see in the case of Jimmy Carter, poor returns during his period, but in particular, Ronald Reagan gained the benefit of the rebound after that with strong returns. And similarly for, you could argue that Barack Obama and also Donald Trump to an extent rode on the gains of the rebound from the GFC. So I think what comes out from here is, if you're an unlucky president and you suffer a big external shock during your presidency, then market returns are going to be weak. But it generally means that the president coming immediately after that will enjoy relatively strong returns.
Yeah, I benefiting essentially from that low base effect coming off the previous one. But as we can see from the list here, it's not that it doesn't always happen, right? Because there have been sequential presidents here where the market has annualized, has grown. But I think over the last 20 years, we can see, 30 years, sorry, we've seen a lot more of those examples, right? Like where Bill Clinton really rode the dot-com bubble and then the dot-com bubble burst, really impacted the Bush era. And just when markets were recovering, the global financial crisis, which gave the Obama administration a bit more, again, a low base effect, which connects back to the earlier data we're bringing up, right? That Republican presidencies have been really unlucky on the scale of things.
Yes. Out of these four on here, obviously, 3 of them are Republican, and perhaps there's an element of just pure luck there. Yeah.
The last question we got on Instagram, Matt, before we've got 2 questions from the audience as well, was, and I think this is a really popular one. Does the White House really hold any sway over market performance, or is the Fed more important? This was an interesting one, and I gave it to you a little bit earlier so that you could.
Yeah, sure. Yeah, I think this is a very good question. I mean, the elections get all of the media attention, but surely it's the Fed that's far more important, and that does make a lot of sense. Politics affects the economy and business in more indirect ways. Various policies might be positive or negative for business. Tax changes might be positive or negative for business, but they're more slow-moving and kind of indirect effects. Whereas the actions of the Fed, in particular interest rates, impact companies' profits directly. And so you could argue that you'd expect the Fed to be more important. There is some data on this. To be honest, the data is not particularly clean in terms of what it shows. There's a nice summary here that shows, the returns of stock markets in falling interest rate cycles at the top here, and in rising interest rate cycles. And they look simply during each cycle, what was the total return of the stock market during the period of that cycle. So these are not annual returns, these are returns over that particular leg of the cycle. And so the length of each cycle might be different. What this shows is, under falling interest rates, the cycle, for example, the S&P returns on average 20%. Rising interest rate cycles, actually, the stock market returns 60%. But I don't think particularly this analysis is particularly so good. More generally, if you think about kind of the impact of the Fed, obviously the long bull market that we've had since the GFC is directly fueled by the actions of the Fed. It's the Fed that implemented quantitative easing. It's the Fed that brought interest rates down essentially to zero in the US and in most countries around the world, that injected huge amounts of liquidity into financial markets. And they are the direct cause of a lot of the bull market over the last 10, 12 years. And so in that sense, it's very clear that the actions of the Fed are very important from a stock market point of view. But when you look at it narrowly in terms of interest rate cycles, the impact is perhaps less clear. This was a nice analysis I found that showed this under rising interest rate cycles. So just looking at periods when interest rates have been going up, how did the S&P perform during those periods? This is a bit surprising. Out of the periods that they looked at, all bar one, actually the stock market rose during the time of the interest rate hikes. The exception here, though, is perhaps the interesting one. March 1972 to 1974, this was when interest rates were being hiked because of the first oil shock. And so the point that I took from this thing here is it very much depends on the reason for the interest rate hikes. It's not just the fact that interest rates are going up is definitely negative for the stock market. It's not as simple as that. It's the reason why interest rates are going up. And so if interest rates are going up because the economy is growing strongly, there's demand pull inflation, then that probably means that companies are doing well. The demand for their products is growing. In general, that's still a relatively positive environment for the stock market. But this case here, where you've got an external oil shock, this is cost push inflation. Prices of energy going up, and the Fed raising interest rates as a reaction to cost push inflation. That's much more negative for stock markets. And so you could argue that the current round of interest rate hikes are closer to this one here in the first oil shock. Obviously, the scale of the increase in the oil price is much smaller this time around compared to then. But you could argue that the current interest rate cycle is more to do with supply cost push inflation, which is more likely to perhaps to be negative for the stock market. But I think overall, it's clear that the actions of the Fed are very important for financial markets, but it's not as simple as just rising interest rates are bad, falling interest rates are good.
Matt, while we're talking about the Fed, we have one question that came in from the audience here. I'm not sure if we can get too deep into this, but they're asking basically for a look ahead. Any thoughts on whether the Fed will be more aggressive with rate hikes after the conclusion of the US midterm elections? Any insights on this?
Yes. Well, if you ask the Fed, they would say obviously we're independent, and we make our decisions based on the data of the underlying economy, and so at least at face value, the elections should have no effect on the Fed. However, obviously the reality is the Fed lives in a political environment just like anybody else. And they will be under perhaps more scrutiny, more pressure with a Republican Congress than perhaps they've had so far under a Democrat, or at least a semi-Democrat Congress. So you could imagine that there'll be more scrutiny, there'll be more tough questioning of the action of the Fed if the Republicans do take control of Congress. And while the Fed will claim that they are independent, you could argue perhaps that higher element of scrutiny might make them perhaps a little bit less aggressive, perhaps, on their interest rate cycle.
All right, another question we have here. Now, this is kind of out of topic, but let's give it a stab, Matt, to see what we can get into. So this question is, and he or she also states this is sort of out of topic region, but what do you reckon of the current European and British climate in terms of investment with Rishi in place and the ongoing energy crisis happening all over in Europe? Also, there has been news of China opening up. Is this the time to ride on the current wave? Essentially, any thoughts on the current situations in Europe and China?
Sure, yeah. Those are big questions.
Big questions may take an entire session for that, but
yes. So let's maybe start with Europe. If you think of Europe from a underlying fundamentals point of view, Europe is clearly weaker than the US, materially weaker than the US, and so expected GDP growth is materially lower in Europe and the UK than in the US. And there's a combination of factors behind that. Obviously, the energy factor is material. The US is essentially energy sufficient. It's a net energy exporter, whereas Europe is a net energy importer. And so the spike in energy prices is a drag on European trade flows, and that is negative for growth. And so in terms of real underlying GDP growth, certainly Europe is weaker than the US, and the UK is already in recession, and most people are expecting the UK to remain in recession for at least a year or so going forward. But of course, the question is how much of that is already priced in. And so you could argue that certainly in the UK and parts of Europe, a lot of that price stuff is already well known, well priced in. And so the question really is, what's the likelihood of negative surprises in Europe relative to the likelihood of negative surprises in the US? And there the situation is much less clear. The US economy has been so resilient in the face of rising interest rates. The US job market, US GDP growth has been very resilient. US profits, US corporate profits have been very resilient in the face of higher interest rates. And so you could argue that if we did see corporate profits starting to slow in the US, that would be more of a shock perhaps than in Europe. So on a fundamental point of view, certainly Europe is struggling relative to the US, but I would argue that a lot of that is already priced in. And so expectations are also pretty low on Europe. If you look at China, so China is obviously part of our investment portfolio. Right now, we have a relatively small position in China. It's about, in terms of direct China stocks, is perhaps 2.5% of our growth portfolio. We don't have a particular view in terms of the economic outlook for China. We're not particularly negative or anything like that. But what does stand out is the fact that stock markets in China have been materially more volatile than other markets. If you just look at kind of realized volatility over the last 12 months, 2 years, say, for example, compare China realized volatility with, say, India realized volatility, then it's way higher in China. We've seen much bigger swings in stock market prices. So clearly, right now, China is a more risky market. And so from our point of view, from our algorithms point of view, we don't see the China market as particularly attractive on a kind of a risk-reward basis. We'd have to see realized volatility in China start to fall before we were our algorithm would be likely to take a large position in China. So from our point of view, it's more a kind of risk-reward kind of element rather than a view on kind of, Chinese economic growth or anything like that.
All right, Matt, thank you so much for your time. And that's all the questions we have for today. Ladies and gentlemen, I hope that you enjoyed today's session. Most of you, in fact, everyone stuck with us till the very end. So thank you so much for your time and your patience with us. Thank you so much for the questions as well. And we appreciate and will continue to learn from the insights, or at least the sentiments that are being sent to us. Matt, a huge thank you to you, CIO of MYTHEO, for taking the time to be with us today. I know it's a bit late in Japan right about now. It's about 11 p.m. your time, if I'm not mistaken. So thank you so much. Ladies and gentlemen, if you'd like to keep up to date with MYTHEO or enjoy our upcoming educational content, please follow us on Instagram or any of our other social media platforms. Goodbye, everyone, and we'll see you in the next one happening the first Wednesday of December. Cheers, everybody. Good night.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio. And that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision-making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.